Good evening, everyone. Let's start with this another chapter. This time we are going to cover chapter 11, which is about prospective financial information and other assurance services. Now, in this chapter, all the standards that are covered are SAEs. Like you can see here, SAE 3400, SAE 3402, and SAE 3420. Now, what's the difference between standards and auditing and standards and assurance engagements, which is the full form of SAE? Now, if we have a look at it, standards and auditing are basically for audit purposes. So, therefore, all the essays are applicable whenever we are doing the audit of historical financial information. Whereas, this SAEs are applicable to all types of engagements other than, like how this been highlighted here, these are for other than audit and reviews of historical financial information. So to cut it short, in this SAEs we are not going to talk anything on the role of an auditor nor on the historical financial information. Then what does it deal with? That is why we have three different standards. Now SAE 3400 deals with prospective financial information. You know that, even going by the simple English, prospective is futuristic. So here it is not about historical financial information, it is the future financial information. And then 3402, that talks about the controls at service organization, and which we will discuss it in a next video of it. Then 3420, that talks about compilation of pro forma financial information. So this is again is a different one, and we need a dedicated class for this. We will discuss. So in this video we would be restricting ourselves to the first one, that is SAE 3400. Now I repeat, having said it is SAE, we are not going to talk on historical financial statements, nor the role of the person is an auditor or a review. So that point we need to keep in mind. Now let's begin. What do we mean by prospective financial information? Prospective financial information is basically a future oriented financial information. Let's come from here. So it is basically a future oriented, and it is highly subjective. Why is it highly subjective? Because it is for future purpose. The financial information here is based on the assumptions. And assumptions about what? Assumptions about future events or the possible actions of the management. Now this may not give you the complete the grip of it. Once we discuss what are the forms of PFI, so probably you will get to it, and I will also take you through what are the practical examples of these cases where this prospective financial information is used. That will give you a basic understanding that is required as to what are these financial information. And once you get a hold on what are this financial information, it would become more easy for you to understand and go through this remaining piece of it. What are the forms of PFI? So either it can be a forecast or it can be a projection. In a general sense, forecast or projection would may mean the same. So because it in simple English, but here there is a difference between these two. What is the difference between forecast and projection? We would see. So to repeat it, the forms of PFI are of three types. Either it is a forecast, or it is a projection, or it is a combination of forecast and projection. This is what is PFI. To cut it short, to explain it in a simple student language, prospective financial information is about the financial information which is presented for futuristic purposes. Then how do you get the numbers? The numbers are based on the assumptions, but how accurate the numbers are, that is what is the difference between forecast and projection. But now, before I get into forecast and projection, where do we use this PFI? So if you look at it, these are the top 5 examples where you would be using this prospective financial information. One is in the prospectus. As you are aware, you would have studied at your interlevel itself, and whenever you want to go for IPO, you need to file the prospectus. In the prospectus, one of the requirement is you are supposed to give your futuristic financial, that is the expected cash flows of this company. So that is where it would come. Or whenever you apply for a bank loan, the banker would be interested to know what is going to be the effect, or what will be the likely cash flows and the P&L for this company. The third one, whenever they are going for business expansion on or setting up a new plant, etc., they want to have the projections. That is where this PFI is used. And as an investor, now whenever you are doing it for the management, now you don't need an attestation. But wherever you are applying for a bank loan, you would have prepared, or whenever you are giving for prospectus, or whenever you're going for expansion or mergers or acquisition or any business plan. If it is for internal purposes, then the management would prepare it and it doesn't require any attestation by a chartered accountant. But in all these cases, there are third parties or there are authorities who would be looking for the confirmation of it. Like, say, for example, to begin with the easier one, the bank one. Now, as a management, you have prepared some the feature financials, but the bank would not believe it because it is you who is prepared it and it is you who want the loan. He want a confirmation of these numbers by a practicing chartered accountant. That is where the standard would arise, or in a prospectus. Now, the management would have prepared it, but the ROC would expect a confirmation, or the SEBI authorities would expect a confirmation of this. And then expansion or a setup. So, wherever you have an investor, so who is investing in this futuristic plan, you would have prepared on your own, but he would get that assurance only when it is certified or when it is attested by a practicing chartered accountant. So, these are the reasons why the standard has come into picture. But the difference between the regular audit and this prospective financial information is, in the case of regular audit, it is easy to do it because you can obtain SAE, since it's all about the historical financial and the transactions has already occurred. You can collect, you can gather the required evidence, whatever is required for you. But when it comes to this prospective financial information, the problem would arise because these are all futuristic. Then if I say that my sales next year are going to be 800 million, how will I get you? I can't give you invoices because these are all my assumptions at this point of time. Or if I say my expenses on this new project is going to be 400 crore. Now, how do I convince the investor? Now, as an practicing chartered accountant, how do I attest? Okay, management may have their own estimations, their own reasons for their estimations, for the assumptions. But as a practicing chartered accountant, when I need to confirm, or when I am required to confirm, or when I am asked to confirm this 400 crore expenditure, how would I confirm? How would I know how many people they are going to have? And at one hand, I insist for SAE before expressing any assumption. So, but where do I get sufficient appropriate audit evidence for these futuristic transactions? That is where the ICI is alerting the members, the practitioners, and what precautions needs to be taken. And because you don't have, you cannot apply the regular audit procedures because the regular audit procedures are more easy to do. You're dealing with the historical. Like, say, if the company says, I've spent 50,000 on travel, you can always ask for the travel bills. You can see the travel ticket and you can see the boarding and lodging expenses. You have something to confirm that expense. Or if they say that I purchased 500 worth raw material, you can ask for invoices, you can ask for your inspection report, you can ask for your store's inward register. There are multiple alternatives, you can get it. Or at the end of it, you can even get a confirmation from the third party. But the problem in this is none of the steps that you adopt in audit are applicable here, because what we are talking here is all the futuristic. So that is where this ICI through the standard is guiding the members on what procedures do I need to adopt, what precautions do I need to take while reporting, because then these are all futuristic and the assumptions, the entire information is based on assumptions. So, therefore, you certifying them for confirmation as a confirmed figures is not acceptable. So, and you don't have an authority, you don't have an you are not convinced yourself for the accuracy of this assumption. So, what precautions are to be taken? How do you structure? And what is the risk that you are taking while accepting these engagements? So, those are the points that we would be discussing here. Now, after understanding what are this prospective financial information, what is the meaning of this prospective financial information, let's move on. Now, in this we said my forms of PFI can either be forecast or a projection. Then comes this one. What do you mean by forecast and what do you mean by projection? To put it in a simple way, the commonality is both are expected numbers because nothing is about the past. Both are expected numbers. Then what is the difference? I'll first explain in a one liner and then we will try to learn it in detail. In a one liner, forecast is the best estimate. Between forecast and projection, both are assumptions. But what is the best estimate assumption is what we call it as a forecast. That is, the management has, like say, the future confirmed orders that you have received for the future period. Now, since you have got a confirmed order, that also can get cancelled. The third party may cancel. But as of now, there is more authenticity to your orders received for a future period than mere estimation of expenses that is going to be incurred on a new project. So, both are assumptions. Like you can see here, this is also assumption, this is also assumption, but this is the best estimate. And because it is the best estimate, the probabilities of occurring these transactions is very high when it comes to forecast. So, whereas when it comes to this projection, these are all hypothetical at this point of time. So, it may or may not occur. Now, to explain that in the form of a difference, what is the difference between a forecast and a projection? So, forecasts are best estimate assumptions, whereas my projection is an hypothetical assumption. What are the examples? Say, example are when you are setting up a new plant, your expenditure, whatever you are assuming, may or may not happen. That is where this word is important. It may or may not happen. Whereas this is the management genuinely expects to occur. This also may not happen, but there is a if you talk about in statistics terms, the probability of these assumptions turning into reality is very high in the case of forecast, whereas here it is little weak. That is the way how you will have to visualize. And then launching a new product or seeking a bank finance or raising funds from the investor, so you are expecting, so these assumptions may or may not happen. That's where these projections are hypothetical. When I say hypothetical, how do they prepare? These are all prepared on what if scenarios. So, and then why do we use them? These are used for evaluating alternative courses of action. Like say, if I get investment from a bank, it is going to be at 4%, but the period of repayment is so and so, and the documentation required is so and so. But as an investor, now the documentation may be little less, but the interest rate is going to be high. So then what is the impact of these on my project? So that is when we use this projections. Or you can take like, what if I use machines in the place of a manpower, labor, so manual versus automation, then I will start calculating the projections. But these forecasts are the best estimate. So these are prepared on the best available information. That is the difference of this forecast and projection. Same thing again as a student learning in your favorite tabular mode. Assumptions here are best estimate, and here they are hypothetical. Then what is the probability of happening? These are expected to occur. So these are expected to occur, but here may or may not occur. And purpose, to predict the future performance, but this is only for evaluating alternative scenarios. And what is the reliability of it? The reliability is higher. This is what we are saying. And the reliability is more speculative. So the reliability is comparatively lower. And example, expected sales growth. Because any owner, any business person, because he is in that field, he will have his professional experience to expect the futuristic sale. Or say suppose if the budget has come out, what will be the impact of that budget on his business in terms of its sales growth? He can expect it. He is an expert in that. He has an experience in that. At the end of it, it may or it may not happen. But considering his expertise in the particular field, that is, you can give little more weight to him. It is more likely to happen. Whereas when you talk about this profitability, if the new plant is set up, or if a new machine is purchased, or if the labor is replaced by the machine, so these are all hypothetical. So this is how you distinguish your forecast and projection. Now, let us go to the examination piece. Say, look at the questions, how you are, because at the end of it, your objective is to face the examination. And unless you see the questions or past questions, how is it being asked, you may not know the way how you have to read and the way how you have to remember. So therefore, it becomes mandatory for you to see the line of questioning. So now let's go to here. SAE 34, I'm reading this question. SAE 34 explains that prospective financial information can take the form of forecast or a projection or a combination of both. In this context, he is asking how do you distinguish a forecast and a projection. So also provide examples. So when he is asking a question directly like this, that is where it becomes important. Now, so having seen that, take 3 stars. He is asking you this both forecast and projection, and mark it as a category in our ABC analysis. So this is required. Now we understood the difference between forecast and this. Then what does this standard deal with? What is the scope of the standard? This scope of standard provides guidance to the practitioners on how do I examine prospective financial information and what are the examination procedures that I should adopt, and then reporting responsibilities. Because since these are all based on assumptions, I must be cautious while issuing my opinion. It shouldn't give in any way that I am going to confirm for the accuracy of that assumptions. So that I should play cautiously. So the language that I have to use, the manner in which I have to confirm, and the additional disclosures that are required, all that would be talked about in the standard. Then where it does not apply? It does not apply to general narrative statements. See, the management will be giving general narrative statements, like say, we are likely to expand to say these European countries, or next year we wanted to expand to all over the world, or we would be touching 1 crore subscribers. They are all generic narrative statements, and there is no financial information in it. So therefore, wherever there is no financial information, this standard has no applicability. But wherever thus the ER futuristic statements are containing any financial information, then the standard would come into the picture. Then come to the next point of it. What is the nature of assurance? Because as an auditor, you are going to confirm the true and fairness of your financial statements, true and fair view of the financials. But here, you can't express true and fair view because these are all futuristic. That is where the standard alerts the practitioner. You cannot express an opinion on the future results. And that too in a manner where you are going to say this will actually be achieved. You can't give that assumption. Why? These are not yet occurred, and these assumptions may change, and at this point of time these are merely speculative. So you can't give your true and fair view. Then what am I going to say? So the auditor only examines, mind this word, he only examines that whether assumptions are reasonable, and whether based on that assumptions whether the information is properly prepared, and the presentation and disclosure. So whether the assumptions have been called out, or because these are all futuristic, by any chance are they giving it in a way to confirm the accuracy of it. So I got to be more careful on those aspects. That is my, so no true and fair view, to put it in a simple student language, no true and fair view. Then what is the responsibility? Now, in this, we talk about responsibilities of the management and responsibility of the auditor. Here, no big difference. Like in the financial statements, historical financial statements, what is the difference? What is the responsibility difference between management and auditor? Management is responsible to prepare, and auditor is responsible to express assurance. Here also it's the same. The management would continue to be responsible for preparation of PFI, sorry, preparation of PFI, presentation of PFI, and disclosure of PFI. So these are the 3 angles, and they must explain the basis. Whatever the forecasts or projections, the assumptions, what is the basis, and list the assumptions underlying. For all this, making that assumption and disclosing that assumption, it is the management who is responsible. Then as an auditor or as a practitioner, maybe the auditor word is not truly proper. So then as a practitioner, so then what is my responsibility here? So the responsibility is examining the assumptions and evaluating the preparation of it and the reporting on the PFI. So I will look at the assumptions, I will evaluate how these PFIs are prepared based on that assumptions, and accordingly I will summarize my report. So these are my responsibilities. Then comes a big question. As of now, we have not started code of ethics. So this point, I need to give the background. See, we have code of ethics, and the ICI through code of ethics is very clear on one point, because auditor should not give guarantee or vouch for the accuracy of future results. So you are not supposed to attest. So therefore, then can a chartered accountant be associated? Because when your code of ethics prohibit you to give a guarantee to, or you are watching for the accuracy of future results, you are not supposed to do. But then can we accept these engagement? Because these are all about the forecast projections and all that. That's where what it says is, even in this, because as a chartered accountant, you are not supposed to give any guarantee or vouch for the accuracy, the way you are reporting is what it matters. So you shouldn't even in the opinion paragraph, you must be very clear, and you also have to provide additional statements to confirm that you are not confirming the guarantee or vouching the accuracy of the forecast, and you are only seeing the reasonableness of the assumptions, and based on that assumptions whether the PFI has been prepared properly. And you also must make sure, this is the important point, all the assumptions must be disclosed and presented in a proper way. So as long as you are not giving your report in a way whereby you are confirming or giving a guarantee or vouching for the accuracy of it, it is fine to accept it. That is what it is. That is where the need for reporting would arise. We will come to it. Then what are the duties of auditor? Duties of auditors are simple. You have to make sure that the assumptions that are made are reasonable, both whether it is a forecast or an estimate, whatever it is, you got to. So either it's a forecast or a projection, you need to make sure it is reasonable, and using that assumptions whether the PFI has been prepared properly and disclosed properly. So these 3 points are very common. It will keep hunting you. First, your assumptions are, you make the assumptions, and based on that assumptions you start preparing it, and once you prepare the PFI, you must make sure to disclose all your assumptions here. All these 3 steps will come either in the way of your procedures, in the way of your disclosures, everywhere. Make the assumptions, prepare the PFI, and disclose the PFI. So disclosures in the PFI, this is going to be. And then consistency, of course. So I must be consistent with whatever the financials, the assumptions that I am making across the periods. That is what is the 4th step. Then what is the nature of assurance? That is what I confirm, what I will not confirm. So since future events, since all these are the future events which have not occurred, the evidence is future oriented. That is my problem. So I can't talk about SAE here. So in its true sense, I need to gather SAE, but not in its true sense of it, because in the historical, to repeat, if it is to confirm the sales, I can check the invoices, I can check the cash receipts of it, I can check the multiple things, I can go for confirmation, external confirmation. But here, these are all feature oriented and outcomes are uncertain. So therefore, auditor cannot express assurance that this will actually be achieved. So you are not going to confirm the accuracy of these estimates. So this is an important point from MCQ. What you give and what you should not give. Then what you should not give, you should not confirm the actually it is going to, the wording should be careful, that is the results will actually be achieved. That statement or that assurance you should not give. Then what assurance I can give? Only I will give, I will express my assurance on reasonableness of the assumption, preparation and presentation. Like I told you here, same point 1, 2, 3. As make the assumptions, prepare the assumptions, and then that is prepare the PFI based on that assumptions, and then disclose them. So auditor does not, he is highlighting one more important point. This is nothing but the same point, but to highlight as an exam note. So, auditor does not express assurance on the actual achievement of the projected results. You must take care. If at all you are giving any assurance on this, then you are violating your code of ethics. So, therefore, you would be subject to disciplinary proceedings. Then, since this is futuristic, take 3 stars to this concept and mark it with A category. That is, what he is asking is, whenever you are accepting this engagement, because this is futuristic, and unless you have the competence to validate that assumptions, and unless you are convinced with where they are going to use, you shouldn't accept it. So therefore, through this standard, it is advising or it is guiding the members as to what are the factors that I need to consider before I accept it. And this will also specifically call out when you are not supposed to accept the engagement. Now, let us look at it. What are the factors? Intended use. Whenever you are preparing, why are you using? Are you using it for genuine business purpose, or are you using it for misleading purpose, misleading the investor? So that I have to take care. If it is prepared for misleading, provide misleading information, I shouldn't accept. And what is the distribution? Is it a general distribution or it is a restricted distribution? If it is a, particularly if it is a projection, hypothetical example, hypothetical assumptions, then the distribution must be restricted. So that we will get into it. Nature of assumptions, same thing, best estimate or that is the forecast or projection which we talked about. And what are the elements that you are going to include? So, because in a P&L, you know that you will have sales, you will have closing stock, and you will have purchases and the opening stock, etc., and all that. And then the salaries and rent and postage, telegram, all that you will have, sale commission and all. But here, since it is a futuristic, you may not be including all that to that detail. Then what are the elements? What you will be including? So that auditor would consider. And then period covered. Why the period covered? Because since this is about the futuristic assumptions, if the period is too long, then the management's ability to make assumptions itself may go down. So therefore, if the period is for too long, that is, if the management is projecting what will happen in next 20 years, then auditor shouldn't accept it, because you will not have, the management will not have the capability to make certain assumptions, particularly if the period is too long. So that is where the period covered is important. Now, when auditor should not accept this engagement, whenever auditor feels the assumptions are unrealistic, it's very clear, or the information that you are presenting is misleading, that is it is inappropriate for the intended use. So meaning, for whatever the use you are saying, that is inappropriate. So indirectly you are going for a misleading information, you are providing misleading information, then auditor should not accept it. Or the reliance on the historical information is not justified, because for making assumptions you are relying on historical data, but that itself is not correct, where a auditor feels that with the change in circumstances, with the change in laws, you relying on the past data for making assumptions is not justified, but the management is doing it, then auditor should refrain from it. Now, so why I said that? Same points here. As a student, maybe you can take a screenshot for your comfort and all that, because once it is in a tabular format, it becomes more easy for the students, and you would give it more weightage to this kind of presentation. Therefore, I am presenting what are the factors, intended use, and the distribution, and the nature of assumptions, and the elements that you are going to include, and the period you are going to cover. When you should not accept, I'm just repeating what we said. When it is unrealistic, or when it is inappropriate for intended use, or reliance on the historical information is not justified. And as I said, I will put that 3 stars here, because as a student, understanding and doing ABC analysis is the most important aspect of it. Now, look at exam questions, so that you will realize why did I say why I have given this A category. Now, Vineet, an auditor, has been approached by some Cube Limited to examine the prospective financial information of the company. So, he is very clear. The moment you see this word prospective financial, this SAE 3400 should strike your mind. And he is asking what factors should be considered by the auditor before accepting the engagement. You know that what you have to write. These are the factors. So it's a straight question, though it is in the form of case study. So, what factors and under what conditions should the auditor decline? So, if you see here, when an auditor should decline or withdraw from such engagement, that is nothing but when he should not accept it. Same thing. So, it's almost a straight question. So, that is how we will get it. And look at MTP question of July 25 for 5 marks. But he has given the same thing, that Vishnu and Co only change in the name of it. But at the end of it, if you see what are the factors that you have to consider and what circumstances that you should not accept the engagement. So, factors and not to accept. Those are the points that we have talked about. So, by now you would have understood the importance of this particular paragraph. So, give weightage whenever you are reading and read good. Then comes this examination procedures. What do you verify and how do you verify? Again, I repeat, at the cost of repetition, I will stress one more point. Your examination procedures here are totally different from audit. For one reason, in the case of audit, what you are verifying is a historical information, but this is not historical. So, therefore, what do you verify? How do you verify? Would become a big point of confusion for the practitioner. So that is where he is giving. How do you determine your NTE? So that is the nature, timing, and extent. What you need to do. Point one: auditor would try to gather the knowledge from the previous engagement on what the client and the business, because since it's all about assumptions and the majority of them are futuristic in nature, auditor should have the complete knowledge of the client and the business. If you don't have the knowledge of the client, if you don't have the knowledge of the business, you may not be able to understand the assumptions, whether it is reasonable or unreasonable. So, therefore, this step is very mandatory. Then, management's competence. That is, you have to analyze, okay, they are making assumptions because the management is responsible for making assumptions. Do they have the capability? Do they have the ability to make these assumptions? And do they have the ability to prepare the financials based on that assumptions? So, management competence is the another point that the auditor would examine. The third point: what is the risk of material misstatement? That is, since these are all futuristic, auditor will see what could be the errors that can happen, the likelihood of it, the errors that can happen. And then dependence on the management's judgment. So, what is the extent to which you have to rely on the judgments made by the management? In a way, though these are the assumptions, but is there a way for you to cross check? Like, I will give an example. Say I'm in the pharma sector. Now the management says their sales are expected to go up by 10%. Now it is the management expectation, but I can validate it. Now if I see some industrial related magazines, industrial related articles, which are talking about, say it is about the budget season or whatever it is. Now there are articles available. What is the impact of a government regulation or the budget on the pharma? So I can compare it. Now the experts are saying it is likely it is going to increase by 7%, but my management says it is my client's management expect it to be 10%. Then I can see that why this 3% more than the industry one. So I can validate it. Say, suppose if the assumptions are something, I can't cross check with any other third party data. So then that is where it becomes difficult for me. So what is the dependence on management? So that is there a possibility, to put it in a student friendly manner, is there any probability or possibility to validate the judgments made by the management? That is what I will see. And finally, the reliability of supporting data. So, whatever they have given, how much I can rely on it. If it is reliable, I will accept it. Otherwise, I will withdraw. And that depends on, the reliability would depend on, is it a budget? These are the bases that you take: the budgets, industrial statistics, agreements, and the market reports. Let's say, suppose a forecast is made, the company sales are going to increase by 30%. Now, if it is a forecast, now why do they say that it will increase by forecast? They've got a confirmed order from a new customer. So, new project has come in. Then see the agreement. Yes, if there is an agreement, in written agreement executed for the future supply of it, then you can rely on it. So, that is what it is. And then the stability of the business. This is important. You are making estimates for the future, but are you going to be there in the future? So, what is your stability of the business? And then auditor's expertise, so, and the experience. Now, what is your experience to even ensure the reasonableness of assumptions with the industry, with the entity, and with your similar engagement? So, these are the points which an auditor would examine. So, if you see here, he is not talking anything on collect the vouchers, do the vouching of it, a test of control. So, those are for audit purposes. That is what I would risk assessment procedures, other procedures, in that my substantive procedures, test of controls, all those language, you don't see any one of it. Therefore, uh, from examination perspective, take 3 stars to this as well and mark it as a category. Why is it so? You can see the questions here. Now, this is September 24 and I mean May 19 and all for 5 marks. What is that he is asking? See, you are engaged by, there is a company called Active Limited, and the moment you see this word, because here it is okay, we are discussing the standard and therefore you assume that the question is from the standard. But the basic challenge for the student is to identify the standard from the given question. So, that is where you need to practice and sensitize your mind. Because you said prospective financial information, your mind should alert you. So, keep this SAE 3400 in mind. Then what is he asking? At the end of it, he has given all that stories, and what are the important matters will be considered by you while determining the nature, timing, and extent of examination. Straight question. So, for 5 marks. So, that is what it is. Why is he asking? To, because these questions will distinguish between a student who had understood the concept behind the standard and who is answering it in a generic way. You have not studied the standard or you have not understood the concepts behind it, then the moment you ask NTU, you start talking about perform the risk assessment, then perform the verify the internal controls, then start doing the substantive procedures, go for test of details, test of transactions. None of those words are relevant in this scenario. That is where this one, and kindly go through it. And then the disclosure. So, what are the disclosures that you need to give? So, the auditor should evaluate whatever the disclosures they have given, because it is about the futuristic. There is no way for you to confirm. Auditor should ensure that the information is informative and not misleading. This is important from an MCQ perspective. And accounting policies are clearly disclosed. So, the accounting policies and the assumptions, it is mandatory, it must be disclosed, otherwise you will be guilty of professional misconduct for certain. And even in the assumptions, you got to segregate yourself in the disclosures and the details of disclosures by what are all very significant, what are all sensitive, and what are all highly uncertain. So, depending on that, you must make sure that the disclosures are reflecting this scenario. And the date when it is prepared, because date is important, because the assumptions whenever you are making, your assumptions hold good as on a particular date. And if any change in the scenarios at a later point of time, your assumptions may not be proper. But how do you demonstrate that these were the facts when I made it? That is why the auditor makes sure that the date of assumption is given in the financial statements. And range of results. Generally, here, since it is about the feature, the range is what they give. So, rather than the numbers, the range of results. So, that is why all the outcomes are presented as a range, and the range is reasonable and the range is not misleading. Changes in accounting policies. In case this is slightly connected to this point, in case there are any changes in it, then whether did you make the statement of fact and what are the changes and the effect of it, that we will have to disclose it. Then report. What are the contents of report? So the examination heading would be contents of the report. You will have the title, you will have the addressee, and you identify, and you must make a reference to this 3400, and you will have to give the responsibilities of both the management and the practitioner. What is the purpose that you have to give, and in case there are any restricted distribution, so that you must identify, and what are the examination procedures you have performed, like we have talked about, because your way of procedures and all are different, you must make it a point to highlight them. And negative assurance, this is the most important one, because the assurance that we provide here is called negative assurance. Mark it, and if the paper is going to be a test on the fundamentals of your concepts, he would ask you this. We will get to the detail. That is what is our negative assurance. And then the opinion on the preparation. And then this point, caveat regarding the achievability. That is, you must make it. This point again, we will talk about it. But that is, you must make sure to highlight that these assumptions or may not happen, and you must make a statement on it. We will discuss. And then these are common: date, place, and signature. So, two things very important here: the examination procedures and this. You must not miss this in quoting the contents of it, because this is where the reporting under this standard would be different from reporting under any other standards. Now, we will talk about these two. Negative assurance. What is negative assurance? The language, that is, instead of confirming the assumptions are reasonable, that is a straight statement. But the auditor will say, nothing has come to my attention to say that assumptions do not provide a reasonable basis. So, if you see the way the auditor is saying assumptions are reasonable, it's quite different. He could have made a simple statement saying, yes, the assumptions are reasonable, but he's not making it. So, he's saying that nothing has come to his knowledge to say that assumptions are unreasonable. So, that is why we call this as a negative, because auditor is starting with a negative word. Nothing has come. So, that is the reason why it is like a direct and indirect speech. That is how the auditor is confirming. And this language, I would say, learn this art of presenting, because if the expected paper is at a tougher level, at a high conceptual level, then he may ask you to draft a note on what is the negative assurance. Then the other important point, caveat regarding the future results. So, the auditor must clearly mention that the actual results are going to be different from the prospective financial. You must alert the reader about it. Why? Because the future events may change, may not occur, or may be uncertain as well. So, therefore, you must make a statement saying that the actuals could be different from what is given here, so that the reader is alerted about it. Then, what are the additional statements that you have to make? Same points. Actual results may differ from this one, and you have to add the statement. You are not giving any assurance on the achievement of it, because if you don't add the statement, it would become you would get into trouble in terms of your code of ethics, and there are chances that you would be categorized, and you may be subject to disciplinary proceedings for professional misconduct. Then, what are, if at all, the additional point? If it is a forecast, it is all right. At least there is a certainty to it. But if it is prepared only based on hypothetical assumptions, then you must disclose the fact, because this may or may not happen. So, that is the probability of your assumptions going wrong is very high in this. So, therefore, if the projections are based on only hypothetical assumptions, then you must disclose them, and you must also make sure that, because this is highly uncertain, may or may not happen, whom are we distributing and what is the purpose? So, the intention of distribution should be restricted to the specified users. That is what he is giving. And then, when are you going to modify your opinion? It's all about disclosure. If the disclosures are inadequate and assumptions are not properly explained, that is, assumptions are reasonable, but the way they have presented is not properly explained, then you would go in for a qualified report. But if it is totally unreasonable, the assumptions are unreasonable, look at the difference between these two statements. Here, the problem is only explanation. But here it is unreasonable. That is why you are going for a qualified, and here you are going for an adverse report. And then if the assumption, the best estimate assumptions do not provide a reasonable basis, it's almost like unreasonable. And if it is improperly prepared, that is, the preparation is not proper, like we have been talking about in the entire standard, it's all about making assumptions and using that assumptions to prepare the financials and then disclose your assumptions in it. So that's where you go wrong. And in the third one, there are scope limitations, because of which you couldn't see whether it is reasonable or whether it is unreasonable. Then you would go in for a disclaimer. This is more easy. And if the limitation is very severe, then, and if withdrawal is permitted, you would go in for a withdrawal. So these are the types of reports. Then what happens if the assumptions are reasonable and the disclosures are proper? Then you would go in for a unmodified opinion, but it will be a negative assurance. You will not call it true and fair. You will only say that nothing has come to my knowledge to say that the assumptions are unreasonable. That is how you will conclude. And finally, to end this, like in any other standard, what is the documentational requirement? So whatever the evidence in support of your assumptions, that you would keep it in yours, and whatever are the procedures you have performed, you would keep it in your documentation. What are all the conclusions you have reached, that you would keep it, and the basis for report. So how did these conclusions were considered for the time of preparation of report? So all this should form part of your report. Apart from this, in your documentation, you would be maintaining this engagement letter, and whatever the additional legal, if at all, if there is a legal requirement for it, then all those additional documents also would come in. So this is the summary of all your standards. But from examination perspective, 3 points are important. So before I conclude, I will highlight the, from examination perspective, what is important. First, the meaning, because in any, while answering anything, though the question is not directly asking you to define, it may be important for you to alert. So meaning is important. And then the difference between forecast and projection, that is the second one which you would be studying. And then you would be studying about the acceptance of engagement. What are the factors and when you should not? So these two are two different, mind you. One is the factors, second one is when you should not accept, we have seen. And the third question is on examination procedures. So these are the important aspects that you must read, so before your exam. So with this, I expect that you would have understood the concepts behind it. At any point of time, if you believe that maybe probably I didn't cover a particular topic to your expectation, just drop in a comment and drop in a message or comment, or whichever the way you can reach out. I will try to clarify it. So, and again, like any other video, I will end with, this is only learning, but you have to test yourself about your preparedness. So therefore, kindly download RS Vidyalaya. It is in your interest. So kindly download it. And I have given all the previous year questions in the form of test papers, and the MCQs are there to test your understanding of it. And then there are case scenario questions for you to practice it. So practice them, read here, understand the concept, practice them. That will only give you a complete package to your preparedness. And at any point of time, if you wish to answer any questions to see how it needs to be presented in the exam, I am the first one to feel happy about it. So go to the app. There is a section where you can upload your answers to it. Upload it, and I will value it and get back to you. So I expect you to give an importance to this chapter, because this is going to help you in scoring the marks. So with this, let us end this video at this point of time, and whenever we are meeting in the next video, that would be on SAE 3402. So till then, have a good break and enjoy your break. Thank you.